Hey there, YouTube. So for this video, I wanted to cover the tax treatment and reporting for unreimbursed partnership expenses. So I've got one slide in front of us here with the rules and some examples, and then I've got a sample Schedule E that we'll look at for John Q. taxpayer when he deducts his unreimbursed expenses. So generally, partnerships are required to file a 1065, right? And then a K1 goes to each owner of the entity. Now, for the owners that are actively participating in the business, because of their material participation, they report line 1, their ordinary income or loss of Schedule E, and then the income is active to them or non-passive rather than passive income. And that's an important distinction because if the entity is generating a net loss and the owner does not materially participate in the company, then the passive activity loss rules would apply. Okay. Now, it's actually quite common for partners in a partnership to pay for business-related expenses out of their own pockets. And then what often will happen is maybe the partnership will reimburse them. So you pay for an expense, submit a expense report to the partnership, and you get reimbursed. But there are circumstances where you would pay for expenses that are business-related, but you do not get reimbursed by the partnership. Okay, if that's the case, then if you meet certain other provisions, you can deduct those unreimbursed partnership expenses on your Form 1040. So you paid for it out of pocket, the partnership didn't reimburse you for it, so the partnership 1065 doesn't have the deduction. You're going to take the deduction on your personal tax return. Okay, so that's what we're looking at here. Now, this is very, very important. This fourth bullet point. In order to deduct unreimbursed partnership expenses, the expenses not only have to be business related, but the partnership agreement must specify that these types of expenses are going to be paid for by the partners, and then they're not going to be reimbursed. And so this was addressed in a recent case, McLaughlin versus Commissioner, where you had an owner who was paying for business-related expenses, deducting them as unreimbursed, but he was denied the deduction because the expenses were traditionally reimbursed by the partnership. So in other words, they're saying, look, if you incurred expenses, you can't deduct them on your personal return because your policy says that you have to submit the claims to the partnership and get reimbursed that way. And then the partnership will take the deduction. So let's look at an example of UPE that is allowed. So we have John here. He's the managing member of this LLC, Consulting Business LLC, and he receives a Schedule K1, which has an allocation of $40,000, a line 1 income. Now, during 2020, John had to drive his personal vehicle to meet clients outside of the home city, right? So his travel expenses were not reimbursed by the partnership. John estimates he drove 1,800 miles for business use. And then if he uses the standard rate for 2020 of 57.5 cents a mile, his mileage deduction is $1,035. Now, the partnership agreement for the Consulting Business LLC provides that John is not going to be reimbursed for travel costs. Okay, so on Schedule E of John's Form 1040, he reports his allocation of the income from his K1, and then he adds a separate line item for the UPE, which is $1,035. So if we look at Schedule E, page 2 for John, right? So Part 2 is where we report income or loss on partnerships and corps, right? So line A here, we have the K1 entry. So Consulting Business LLC, it's a partnership. There's the EIN. And then if we go down here to a line A for that same K1, we have the $40,000 of non-passive income, right? Because he actively participates in the business. So given his material participation, we're treating it as non-passive income. So there's the $40,000. Now, in order to record the UPE, he adds a separate line item, unreimbursed partnership expenses, right? And then line B down here, we have the non-passive loss, right? So we have a net expense entry. So the $1,035, that's the unreimbursed travel costs. And again, it's non-passive, right? Because this is a materially, he materially participates in the entity. And so when you net all these amounts together, right, we have this $40,000 in income, we have the $1,035 in expenses. So the net income or loss that is going to be passed through to his 1040 on page 1 there is going to be 38,965. So that's how he's getting the benefit of his deductions. So if we go back up to Schedule 1 here, we can see here, right, line 5 item, rental real estate, royalties, partnerships, S corps. That's the net amount that is going to be subject to tax on John's return, right? Not the 40,000, right? He gets 40,000 minus the unreimbursed expenses. So if we look at an example now where this would not be allowed, let's say Adam is a managing member of Restaurant LLC, which has 5 other owners. During 2020, Adam would regularly go to the store to buy supplies for his restaurant. The agreement provides that the owners are to be reimbursed for all business expenses which they use their personal funds to purchase, right? So during 2020, Adam put $8,000 of supplies and materials for the restaurant in his personal credit card, right? So Adam submitted expense reports for $6,000, which were reimbursed by the partnership. However, he forgot to submit expense reports for the extra $2,000. Now, under this fact pattern, Adam is not permitted to add those extra $2,000 worth of expenses as UPE because the expenses are ordinarily reimbursed by the partnership. So he needs to go to the partnership to get reimbursed for those costs. He can't just add it to Schedule E, page 2, like we did up here for John. Okay. So that covers it for this slide and video. I hope that was helpful. If you have any questions, leave me a comment below. And I look forward to seeing you again soon. Thank you.